when you're ready.
Sure.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. I'm joined today by Sahm Adrangi of Kerrisdale Capital. Kerrisdale are well known for their short selling. They're a special situation, event-driven special situation characterized by deep research and some great research reports which they very generously share with the market.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Sam, thanks for joining me today.
Thank you. It's good to be here.
My absolute pleasure. So I think that the way that most folks probably you came to prominence with the Chinese reverse mergers. That was in, what year was that?
So it was 2010.
So
2010 when it all began.
We had been emailing back and forth in about 2009 about some nets that I used to run on the old blog, greenback.com. So how did you find the Chinese reverse merger frauds? What was the catalyst there?
Sure. So I launched my fund with $300,000 middle of 2009, July 2009. And, I'd never been a portfolio manager before I was 28. And so really the idea was to start putting together a portfolio. And so back then, like a lot of people, I was just getting ideas from the internet. And so that's how I came across, I think it was Coventry, that you'd written about on your blog, and I took a closer look at. And, I think that's when I reached out, and it was one of the first longs I wrote about in 2009, 2010, and it was this net. And I can't even remember exactly how it turned out. It was just one of these liquidations. Yeah. I think we made money off of it. I remember the CEO got sued, and you didn't know whether proceeds were going to come from that or whatever. But yeah, I was getting a lot of my ideas off the internet. And around then, SumZero had launched. And, many of your followers may be familiar with SumZero. For those who aren't, SumZero is a platform where mostly professional analysts trade ideas with one another. And I would just sort of scour SumZero looking for ideas. I was member number 100. I knew Divya and Alip personally at the time when they launched it. And, I would just sort of make connections with other folks sharing ideas on there. And, I remember at one point, one of the guys I was speaking with said, "Hey, you should take a look at this idea." It was a SPAC buying a Chinese company. And as I looked deeper into it, it seemed like a great financial engineering opportunity on the long side. So I made sort of a big investment 5 months into my fund. It was sort of a binary trade. I put 10% of my capital into this binary trade where it was either going to go to zero or it was going to at least double. And I sort of took the rest of the month off. I'm like, you know what? Either my hedge fund's over after 5 months or I'm up 20 or 30%. I started working on my website. I hadn't built a website then. It's probably good working on the website since it's become such a big part of our business at this point. The trade worked out. We had a good November in 2009. I had my first 6 months under my belt, and I had a finished website. But, after that, after the SPAC acquired this Chinese company, I looked, more deeply into whether, what was going on with these businesses. And after 6 months of analysis, I realized they were committing fraud, and then it was off to the races.
So the first one that you wrote about was China Marine. Do you remember China Marine?
Yeah, China Marine Food was the first one. And the reason it was the first one, there were a lot of these companies, right? And one of sort of my bigger breakthroughs in sort of discovering that they were committing fraud was, back then there wasn't Seeking Alpha really. Seeking Alpha was existed, but nobody really wrote anything substantial on there. What was actually a great area to just sort of talk about stocks was Yahoo Finance. And so I was sort of just always reading the Yahoo Finance. As I was just doing my diligence on these Chinese reverse mergers, I was reading the Yahoo Finance message boards, and there was this one guy who was writing under a screen name, turned out to be a 70-year-old businessman in Austin, Texas, that just liked to trade stocks on his own. And he started doing this work where he was pulling these Chinese filings from China, and the filings from China were showing like $1 million of revenue, whereas the U.S. filings were showing $100 million of revenue. And I started doing the same thing for a bunch of companies, for like 10, 20 companies that, I'd been looking at. And China Marine was one of them, where it was reporting a couple $1 million versus like $100, $200 million, that it was reporting in the U.S. The reason I did China Marine first was because as part of my diligence, I wasn't simply just reading docs. I was going to the conferences, and I was just trying to talk to people. I was trying to talk to the bankers that did these deals. I was trying to talk to the sell side analysts. And one of the groups of industry folks that I was trying to speak with was the pipe funds that seemed to be the original seed investors in a lot of them. And I was sort of like looking for these guys. There was a very small handful of pipe funds. Most people wouldn't recognize them. But I ended up getting a lunch with one of them. And I was 28, 29 at the time. I managed $300,000, $400,000 now, maybe $360,000 at this point after my, returns in 2009. And I had lunch, and, I just started talking to him. I talked to him about these filings I was pulling. He was curious about them, and he was behind, he'd seeded a bunch of these companies. And I think as sort of the lunch continued, and he got more comfortable, we're on a third, fourth glass of wine. He started like telling me some of the stories that he'd seen in China. And he had a team in China, he probably was invested in 20 or 30 of these businesses, but he'd seen hundreds of them, right? His team had seen hundreds of them. So he started telling me stories about the fraud. He'd be like, yeah, we'd visit this one company, and it was an entire boarded up building with like padlocked doors. We'd visit this other company, and, there'd be like nothing in the factory. And always, the companies where there were blatant fraud were the ones he wasn't invested in. It was all the other ones that were like
the ones that weren't blatant frauds.
Yeah.
They were frauds, just not blatant ones.
Yeah. But anyway, so he started talking about China Marine food. And, he started telling me a few stories about China Marine food. And I remember their Chinese filings hadn't matched their U.S. filings. And I had this sort of like pipe investor that was invested in a lot of these saying, hey, this one's not real. And so that ended up being the first one I decided to go forward with. And as I did my diligence, a bunch of pretty funny stuff came up. I remember originally I wrote an article that said, hey, their U.S. filings and Chinese filings don't match, and a whole bunch of, things about their margins and their working capital didn't make any sense. But then as I continued to do research, I realized that their accounting firm was this Hong Kong accounting firm that only had two partners, right? They're generating $50, $100 million of revenue each year, and it's a two-partner firm. And then I started doing more work, and I realized that one of them was in the midst of a lawsuit getting sued by a Danish investor for defrauding that Danish investor by putting that Danish investor into one fraudulent, like, Chinese private entity. Then when that guy lost money on that entity, he's like, all right, well, sorry that one didn't work out, but why don't we take the money that you had, put some more money into the second thing, and then into a third thing. By the time the guy had gotten duped 4 times, he filed a lawsuit against the accountant. And this was the accountant of China Marine Food. And so I'm like, I decided to move forward with that one. And, it ended up being a successful trade, and that stock declined dramatically. And it was part of an SEC enforcement action, I think, a couple years later, that really brought by the SEC against that company's U.S. accountant. I think it may have switched from the Hong Kong auditor to the U.S. accountant, but I think it was subject to an SEC enforcement action at some point a couple years later.
And so the next high-profile Chinese reverse merger was China Education. Do you want to tell the story there?
Yeah, China Education Alliance is sort of one of the sillier frauds that we've exposed. And it was early on. It was November 2010. It was just when, the whole fraud exposing thing was gaining steam. And China Education Alliance, half of its business was in an online education website where high school students would go and get test prep in order for their end-of-year exams. And I had someone who speaks Chinese visit the website and, just look through it, and he came back and said, like, everything's broken on this website. None of the links work. You can't even pay for anything on the site. And so this company is reporting 50% growth each year, yet you can't actually purchase anything on their website because they haven't bothered to like update the website over the past year. And so we created a video where, you know, this person just simply started clicking on links and showed all the dead links. Like, American investors couldn't necessarily see that, but, you know, but this person spoke Chinese and English, and so he was able to demonstrate, you know, how the site was broken. And so that was half the business. And then the other half of the business was a training center. Think of like Princeton Review with its classroom centers. And we had someone go visit the building, and completely vacant building. We had the right address, right everything, but, you know, the actual educator that was occupying the building, and it wasn't China Education Alliance, had vacated the building 6 months before, and so there were just no chairs, no desks. So we put together a video of that. I think both of those are on the internet somewhere, and exposed the company, and you know, it was a very profitable trade for us, and you know.
Yeah, that's funny. I knew a local firm in Los Angeles that invested in Sino Forest.
Oh, yeah.
I don't know if you remember that one, but that was...
My dad was invested in Sino Forest, and I knew Carson at the time, and after he exposed him, I'm like, dude, you just like lost my dad $50K. Not cool. It's like, sorry.
Well, this firm is a pretty big firm. They put $100 million into this, and they did extensive due diligence, including sending an analyst to China who took them to a forest and showed them the forest, but they didn't own it. So that's a trap that you have to be careful of.
Yeah.
So the more recently, possibly the thing that you have been best known for is in telecommunications was Globalstar. Do you want to tell the Globalstar story?
Sure. Yeah, Globalstar was probably my favorite campaign outside of the Chinese frauds. You know, in this business, sometimes you find shorts that you're very excited about, and you feel like you've definitively proven that it's worth zero. And then in other situations, you know, like much of investing, based on your diligence, you think that you're probably right. And if you've done your work, you usually are, but you don't have that same level of conviction as other situations. Globalstar was an exciting one for us because the company was trading at $5 billion, enterprise value, $4.5 billion market cap. And we felt that we'd proven definitively that the stock was worthless, which was just very exciting. And our thesis really wasn't out there in any way, shape, or form. It wasn't on any websites. Nobody had really done the level of work that we'd done and come to our conclusions. And so we got so excited by it, we made it a large position. And you know, this was a year and a half after Bill Ackman's Herbalife campaign, and I'd sort of watched that just as part of studying what other short activists were doing. And so we decided to rent the same auditorium, the same live streaming firm, and we even created the same a website. His website was Facts About Herbalife. We created a website called Facts About Globalstar, which is still live. And I gave a 3 or 4 hour presentation on why this company's Spectrum was worthless. And that's really what, you know, the company's $4.5 billion valuation was based on. It's sort of the Spectrum value. And, you know, it was a really exciting one for us. It's sort of, to this day, the only live presentation we've given. I think us and Ackman are really the only two firms that have rented out our own auditoriums for our own presentations. I mean, there's folks that go on to, you know, these conferences, Robinhood, Arizona, and present amongst many other speakers. But it certainly takes, you know, it's another level to just rent your own auditorium, create your own event. And, you know, it was an exciting one. And
well, it worked, but do you remember the thesis?
Yeah, so in the case of Globalstar, it basically had Spectrum. So it's a satellite company, and many of these satellite businesses oftentimes end up being worth more for their spectrum than the actual satellite business. You know, satellite connectivity, you know, continues to lose ground to terrestrial competition, and Globalstar made phones that could be used in places where you can get cell phone connectivity, but nowadays, you know, outside of, you know, if you're hiking in really remote areas, you know, you're going to get Verizon or AT&T or T-Mobile signals, you know, just about everywhere. You don't need a special phone. And so, whereas, you know, these satellite companies have to spend billions of dollars to launch these satellites into space, to serve, ever shrinking markets. And on top of that, Globalstar was sort of the worst provider relative to its peers. And so the satellite business was just not worth very much, certainly not worth $4 or $5 billion. But the spectrum that it was using for part of its wireless operations is in the sort of the 2.495 gigahertz band, I think. And that's sort of roughly around where Sprint's 2.5 gigahertz spectrum is, and some of the other LTE bands, other bands that the wireless players use for LTE. And so there was just sort of very basic thinking out there that this spectrum was potentially very valuable, worth billions of dollars. But it wasn't, because it's not simply about the location of your frequencies. It depends on who your neighbors are, who you're sharing the spectrum with, the width of it, how it sort of plays into the current wireless generation, upcoming wireless generations, and for a variety of reasons. Globalstar Spectrum, which was getting valued at $4 billion, was actually worth nothing. The main reason is the same reason that Light Squared has gone bankrupt multiple times. At the end of the day, it has the wrong neighbors. Light Squared Spectrum had GPS as its immediate neighbor, and so there was interference between its bands, had it been enabled for cellular communication, and the GPS frequencies immediately adjacent to it. In the case of Globalstar, it was immediately adjacent to Wi-Fi. And so if it was ever converted to high-power cellular usage, it would cause interference with the immediately neighboring Wi-Fi. And so this spectrum was just never going to amount to anything because it had the wrong neighbors.
And so can you contrast that with your experience with Straight Path?
Sure. So Globalstar is a spectrum story we got dead right. Straight Path is a spectrum story we got dead wrong. In the case of Straight Path has very high frequency spectrum. And so certainly, if you went back 5-10 years ago, the idea that these frequencies would, ever become valuable, I think, a lot of experts in the field would sort of cast doubt on that, because, as you go higher up in frequency, the signal strength gets exponentially weaker. And, most of the frequencies that are used for LTE or sort of current wireless communications are 2.5 gigahertz or lower, right? As you start getting to 3 gigahertz, 4 gigahertz, 5 gigahertz, the signals become exponentially weaker. And Straight Path spectrum was in 29 gigahertz band, the 36 gigahertz band, right? So dramatically higher than what's currently being used. And then the other issue with frequencies in that high of the spectrum range, nobody else is using them. So there's hundreds of megahertz, there's gigahertz totally available. It's not like Straight Path's bands are the only frequencies available. And so we just felt it wasn't worth more than a couple $100 million. The issue is that, wireless technology has been advancing pretty dramatically over the past 5 years, given just the exploding usage of cell phones, and there's just been a lot of funding that's gone into that line of work. And so, engineers have been able to find ways to make use of these very high frequency bands. And although there's a lot out there, Verizon, AT&T, and Sprint were willing to spend a couple $2 billion to get their hands on something that they could start deploying 5G on. And so 5G technology will be using these very high frequencies. Straight Path ended up becoming an asset that folks wanted. And so we thought that the frequencies were worth a couple $100 million. In the end, I think it was about $3 billion that Verizon ultimately paid for it. And I think, on sort of one account, no short activist has ever been more wrong on a name than we've been wrong on Straight Path. We said, and the stock was trading, I think, around 40. We said in January 2017 that it was worth like $20. I think within 3 months later, it was bought out at $180. So,
ouch.
Yeah.
You've clearly got some expertise in telecommunications, and that's reflected. You've also got a long or you had an activist long in Intelsat. Do you want to talk about Intelsat?
Yeah, so then in the case of Intelsat, it's another satellite company where the satellite business is under pressure, not worth a whole lot in terms of as a revenue, has a multiple of revenue or EBITDA. But they've ended up sitting on an extremely valuable swath of spectrum. They use frequencies between 3.7 and 4.2 gigahertz for linear TV broadcast distribution. So, if you've got a Disney studio in Los Angeles that's sort of making broadcasting certain shows, etc. Those signals, in order to get to maybe the other side of the country, will go up to satellites and then go back down to cable head ends in Washington D.C. And the frequencies used for those TV broadcast signals are between 3.7 and 4.2 gigahertz. The mid 3 gigahertz band has become a prime area of unused spectrum that 5G technology can take advantage of. And so, Intelsat and SES, the other main user of this sort of 3.7 to 4.2 gigahertz band. And this is a small part of both businesses. They approached the FCC in 2018 or 2017, late 2017, and pitched the idea of sort of reconfiguring their usage within 3.7 to 4.2 to be able to take some of that spectrum and sell it to Verizon, AT&T, or Sprint, or T-Mobile. And I think the ultimate proceeds that they could get from that are going to be in the tens of billions of dollars. And those proceeds sort of dwarf the market cap enterprise values of these companies. And so, it makes the stocks multi-baggers. And when we published on it last year, the story really wasn't out there. There were just a few glimmers that, the spectrum might be valuable and the FCC proceeding might play out to their favor. But there's been so much disappointment in the history of satellite companies trying to make money off of their spectrum holdings that, I think there was a lot of skepticism. But this is a situation where the stars did align, and we believe have continued to align. And much of what we predicted, in the middle of last year about how the FCC process was going to proceed and the potential value of the spectrum, as has played out. And it's still one of our largest investments. And we're particularly excited about Intelsat and its ability to sell this 3.7 to 4.2 gigahertz spectrum to the wireless carriers.
So you guys also have a focus in biotech and mining. Do you want to talk a little bit about Pristina?
Sure. So Pristina is a situation we end up publishing on biotechs a couple times a year, typically, and a lot of the names that we published on are companies that are getting valued $1 billion, $2 billion, $3 billion because of a single drug that's undergoing phase 3 trials. And given that biotech's been a hot space over the past 5 to 10 years, you have situations where investor expectation around phase 3 trial is sort of resulting in, or success in a phase 2 trial is resulting in, multi-billion-dollar valuations. But if you actually sort of dig into the mechanism of action and you look at the phase 2 data, you come to the conclusion that it's very unlikely to succeed in that phase 3. And to the extent they fail phase 3, these stocks are down 70 or 80%. And we get excited about that on the short side because in terms of short activism, we can go out and we can say a stock is worth dramatically less than where it's currently trading at versus worth 20, 30% less. And so, we've always poked around in the biotech space. We've built out some expertise there. And Pristina was a situation where, the company was getting valued at $2 billion, $2.5 billion because of one drug. And we felt within 6 to 12 months, the trials were going to read out for that drug. They weren't going to be successful in terms of allowing the trials to meet their endpoints. And I think when that phase 3 failed, the stock had a lot of downside, and it turned out to be the case. I think they ended up failing that trial in sort of 7 or 8 months later, and the stock's down 70, 80%.
And on the mining front, how about First Majestic?
Sure. First Majestic was a situation where silver prices had gone up a lot, but the stock price of First Majestic, one of the larger silver mining companies, had gone up a lot more. And the best way to just sort of assess that is to see this company's valuation based on its sort of stock price relative to its NAV and how much of a premium, had started to get built in there. So a lot of times these silver miners were sort of trading. I mean, a lot of the comps were trading maybe 1 to 2 times NAV. First Majestic had gone up to 4 to 5 times. And so, unless there was something special about their silver relative to the other silver miners, this valuation premium wasn't justified, or if there was something, special about the management or, potentially future acquisitions, et cetera. But, to a large part, it was sort of business as usual for First Majestic, the company. The market had just gotten carried away because silver prices had increased significantly over the prior 6 months. And so what we did there is we went short First Majestic, we went long a basket of other silver miners. We wrote a report that's saying that this sort of NAV premium just makes no sense. So that's First Majestic.
You've got a very broad range of industries that you look at, from telecommunications, mining, biotech, started with the Chinese reverse mergers, and you long and short. What's your process for finding positions, and when you're looking at them, are you thinking long or short, or how do you handle that?
Yeah, so we've got a team. And I think one thing I've just noticed about investment professionals is that, there are differences among different folks. Some people look at a ton of ideas and winnow them down to a much smaller number of names. Some analysts like to build expertise in certain sectors and mostly focus on those sectors and leverage, what they've learned over many years. And different members of our team sort of do things differently. Just in terms of myself, I like to jump around. It's sort of like the ADD in me. Sometimes I'm sourcing ideas from the idea sharing websites. Sometimes I'm using screens. Sometimes I'm revisiting a company that I looked at 5 years ago. But over time, as you look in more and more investments, it's not about how you source ideas, but understanding what diligence you need to have done to get enough conviction to build a position. And then especially, when to move from making something a 1 or 2% position to a potentially a 10, 15, 20% position, and those are the situations where you can make real money. And I think the skill in investing in the public markets has a lot more to do with not where you source your ideas or how you source your ideas, but how you navigate that sort of continuum of when you've done enough research to make something a position, and when you've done enough research to take a small position and make it a large position. But what I found is where we actually get the idea, can really vary.
Yeah, so in terms of managing the portfolio, moving from smaller positions, starter positions in the 1 to 2% range to conviction, is that what you regard as sort of 10 or 15% is as concentrated as you'll go from the outset?
No, we'll get more concentrated.
How big are you at inception?
Well, I'll make something 50% if I have the conviction on it. One of the things that we do is we don't just sort of make an investment and sit on our hands. I think if you've developed enough conviction to make something that large, then it shouldn't take that long for other market participants to see what you're seeing. Some of these very attractive investment opportunities can be fleeting. There's multiple times in sort of over the past 10 years of running a fund, I've sort of seen opportunities that seem just really exciting. The stars have aligned with respect to, that stock and why its valuation should be higher, and you just really can't come up with an argument against it relative to what the market is or how its peers are trading, etc. And oftentimes they don't stay at that depressed valuation for too long. And so in those situations, where we've made something a big position, we go out there and we try to sort of tell everyone about what we know, right? We'll call the sell side, we'll call the holders. Unfortunately with us, we've built a brand. We've got 31,000 followers on Twitter, thousands of followers on our email lists. And we'll write up the idea and we'll use those platforms as a way to sort of get the thesis out there. So we can start hearing what other people have to say about it. We can sort of get our views out there. Sometimes we'll get feedback that comes back and, points holes in our original thesis, and we'll be like, oops, this shouldn't have been a 50% position, or not that we're building 50% positions left, right, and center, but this shouldn't be a 10% position, 15% position. Even if you make something a 12% position, if you get it wrong, most funds can't withstand, 600 basis points losses on a given name. But we look forward to opportunities where, internally within the firm, both the investment team and myself are really excited about an investment. So we can make it large, write it up, and share our ideas out there and go and try to get others to view the stock the same way we do and potentially generate some outsized P&L for our investors. Or, if we find out that we're wrong, we'll sort of exit the position, reduce the position. But I like searching for those opportunities and investing that way rather than building a diversified portfolio of a bunch of 2 or 3% positions, because the reality is it's sort of a worse way of doing right by your investors or generate returns for your fund. Like it's worse investing when you get too diversified, in my opinion.
And how does your exposure run? Do you aim for any level of exposure, long or short, net, gross?
Well, we historically, the fund was really designed just to generate returns. It was a lot of my personal capital. I didn't know as much about sort of the hedge fund allocator community and what hedge fund investors were looking for. I'd never really been in the seat of some family office that maybe has $500 million because of a founder that sold his business for $1 billion. And when they sort of took that capital, they sort of put $150 million and $200 million into equities, and 70% of that would go into various ETFs, low cost, just beta exposure. And then when they look to their hedge funds, they really wanted just something as an alternative to that. And so oftentimes when those investors look at funds, they're looking just for a product that can generate returns for them, but withstand volatility, during market drawdowns, mostly because of what they have in the rest of their portfolio, right? When I first started, I'm just like, I'm just going to create a vehicle that's going to make as much money as possible in the public markets, right? So we used to run a higher net back then, but over the past couple years, we've changed that dramatically for a variety of reasons. So today I run a much lower net, 20 to 30%, 20 to 40%. Whereas in the old days, it used to be 70 to 90%, and that was fun. But, I think today and going forward, what we try to do is we run 20 to 40% net, and we try to generate meaningful returns for our investors, double-digit returns for our investors year in, year out, but without, suffering significant fund drawdowns when you get an overall choppy market. That's what we try to achieve.
So when you're the 50% positions, that's on the long side. You're not putting a short on at 50%, or are you putting a short on at 50%?
Yeah, it's much more on the long side. On the short side, you have tail risk. Stocks can go up an infinite amount, and so certainly have to be more careful there.
How large do you get on the short side?
It varies. Depends on the ideas. I mean, we have built 20, 30% positions, but, sometimes those stocks are very big. So you're not necessarily, if a stock trades $500 million a day, building a $50 million position isn't quite as risky as if it trades $10 million a day. So it varies, it's case dependent. I think this whole logic about concentration makes a lot more sense on the long side than on the short side. We're short activists, and so, we've got a following of folks that will pay attention to our ideas when we publish on the short side, and, that can be powerful. Whereas on the long, that can help us justify, building larger short positions. But because
you act as your own catalyst?
I wouldn't necessarily put it that way, but I think, your average investor, when they share their research to their followers, they haven't built as much credibility over many years. And so Morgan Stanley sell-side analyst is less likely to pay attention to their research. Whereas for us, we've just built credibility, we've built a following, built a reputation for doing very high-quality research. So certainly in certain sectors, when we publish on them, the sell-side pays attention, and that can be powerful. I think the spectrum space is a good example of that, right? Some of the analysts that cover satellite players and spectrum stories, they remember when we published on Globalstar. They remember when we published on Dish, right? Dish was a very large company, and we had a very contrarian view at the time that Spectrum was being valued much too highly. Most analysts covering Dish were either bullish on Dish or they felt there was a lot of potential upside such that they would never really have sort of a negative view on Dish given, how much Verizon could come in and potentially buy them out for. But, when we studied the situation, we felt that the vast majority of paths, nearly all paths, led to a lower stock price for a variety of reasons specific to Dish. And so, we published that report, and I went on CNBC, and I highlighted our thesis on the short side, and, there was a lot of volume in the stock, and a lot of the holders reached out to the sell side and talked to them about our thesis, and, a lot of what we'd predicted turned out to be right. And I think that stock is down materially from when we originally published on it. It's sort of retraced it this year, and I have no idea why. I have no idea why Dish trades where it trades. I think it makes no sense whatsoever. Totally nutty. But a lot of what we sort of predicted in terms of how that situation would play out has turned out to be true. So that now when we publish on a Spectrum story, sell side pays attention. The longs that sort of traffic in this very niche space will pay attention, and I think it can be powerful. It's something that we continue to try to cultivate. We try to cultivate a brand because it can be helpful in the hedge fund arena.
So as we're coming to the end, when you're thinking prospectively about fertile areas for continued research now, do you look at something like software as a service? Is that a good sector to be digging into?
On the short side?
On the short side.
I think valuations are stretched in the SaaS space. It's just we don't strive to publish on names where the companies are going to become much larger 5, 10, 15, 20 years from now. And the reason is because it ends up being a bit of a call on the market's view on valuation, right? Look, we live in a 0 or 1% interest rate environment, right? And every company is worth the present value of its future discounted cash flows. If you plug a 1% interest rate into your DCF, it applies an S&P multiple of like 100 times PE or 70, 50, north of 50 times PE, well north of wherever it's trading, where the S&P is trading right now. And so if a company is going to become much larger 10 years or 20 years from now, maybe we're just sort of in this world where if 1%, 2% interest rates persist, that you're not really right mathematically on your short thesis. Versus a biotech where it's going to fail its phase 3 and, there are no potential revenues, or a situation like Globalstar where the spectrum just has no value, under any circumstances. So companies where, that aren't going to be larger 10 or 20 years from now, we're fundamentally very right about our short thesis, whereas, a SaaS business that is trading at 25 times revenue that we should be trading at 15 or 10 times revenue, could just be a tougher call, That's I think people valuation shorts get a bad rep, and a lot of short sellers they try not to do valuation shorts. I think the one thing people don't talk about is that there's a real mathematical argument for why valuation shorts aren't good shorts, and the math behind it is that the DCF for fast growing companies will spit out very high values if interest rates are low. And interest rates have been low for a long time. They are low. I think they might continue to be low for a very long period of time.
Well, thank you very much for talking to us. If folks want to follow along with what you're doing, what's your Twitter handle?
Yeah, so our Twitter handle is Kerrisdale Cap, KerrisdaleCap. Our website is www.kerrisdalecap.com. There's a submit button at the top of the website, and visitors can sign up for our research from that site. And yeah, we'd love for some of your followers, if they're interested by this podcast and want to learn more about our research, to follow us on Twitter and sign up for our email list.
Well, thanks very much. Sahm Adrangi of Kerrisdale Capital.
Thanks, Toby.